All right, I'm recording. Okay, guys. So welcome in, everyone. I appreciate you for joining. This is a topic that this is probably the most important lesson for beginners. Our first topic was introduction to options and the markets and all of that, so you guys can get a feel. But that is all fun and stuff, right? You learn about options, you learn how it works, you learn how to buy and do all of that cool stuff. But there comes a point where you can paper trade, which paper trading is for for fake money, right? You can practice, see how it feels, get a feel. But then there comes a point where you want to start making money, right? So that's where you're gonna be trading with real money. So this lesson will help you tremendously with that. So guys, the like I said, the this is the second segment, and the title is as follows. Let me copy this. How to never 100% guaranteed blow up your portfolio. And I title this as an intermediate lesson because you should be able to have some understanding on options and stuff. So let me go ahead and do this. Okay, guys. So this is the number one issue that beginner traders have. Okay, and it's blowing up your portfolio, right? So, like I said, before I started recording, losses are guaranteed, right? If you guys are gonna get into this, any type of trading, not just stocks, right? There's gonna be losses that come with it, right? So you gotta accept that first before you even start doing this, right? You need to accept the fact that you're gonna lose, man, and you're gonna lose every week probably. And but the most important thing, right, is how do you
Yeah,
manage those losses, right? Do those losses affect you? Do those losses outweigh your wins? Right? So to be profitable, you need to accept the fact first that you're gonna have losses, right? And it might not be every day, right? You might not have a loss every day. There's people that, can go 3 days without losing, and then one day they just lose a lot. So the number one issue with new traders, like I said, it's that psychology and how to not be addicted, not addicted, but greedy. Because guys, when it comes to money, um, everyone likes their money, right? If you think about the world, guys, I hate when people say, "Oh, that's such a money grab," right? Every business in this world is a money grab, right? Like, what is the point of starting a business? What is the point of doing anything if it's not for money? So everything is a money grab. So when people trade, they treat it like a money grab, right? But there comes a point where you need to know the difference between a money grab, because trading is not something that you do or you're not supposed to do just for one day. Money grab and that's it, right? You gotta focus on, the next couple months, next couple years, if this is something that you want to take seriously. And obviously, if you do take it seriously, you can reach very far, like myself and my team has done. And we have all the results to back it up, we have all the statistics to back it up. And the number one thing that will differentiate you between the kid that just trades for a week or trades for a couple weeks versus the person that actually takes it seriously and commits and stays consistent is this, guys: greed. And what do most traders fail? Greed, and they blow up their portfolio, right? And I won't sit here and lie to you guys, right? I have blown my portfolio. Be like when I started trading almost 3 years ago, right? Nearing 3 years ago. So I've blown multiple portfolios, and what blow means is basically like when you lose all your money in your account, right? So this lesson is very, I want to teach you guys how you cannot let that happen to you. Okay, so this is not going to be the classic stuff that you're gonna find on YouTube, right? If you go to YouTube, you'll see all the stuff about risk management, all that basic stuff. And yeah, all that stuff is logical, and that's good. But there's certain psychological things that come into play. And me as a full-time trader, I'm here to tell you guys that. And these kids that are making YouTube channels and making tutorials, right? They're not full-time traders. They're making tutorials, but they've never been in the game for years like I have, right? And this tutorial is not a public video, right? It's just for you guys here. So that's why I'm here to show you guys. And by the way, if you guys have any questions while I'm doing this, you can type in the chat, or you can just talk to me. I don't mind. All right, guys. So this is my course, like I said, right? Probably you guys need to understand the two differences, right? And there's two key differences when you're trading. It's your account size, right? And the size of the trade. So you need to always keep into account, if you see a trade that costs $500, right? And your account is at 600, that's probably not, a wise move to enter that trade. Why? Because you're going to be most of your account is going to be in that position, right? So your leverage, and guys, remember, pretty much if you want to get rich, there's people in this group that own businesses, there's adults, there's everything, right? But the number one way to, create that freedom is leverage, guys. You need to leverage your life, right? And yeah, I know this is about trading, but leverage is pretty much what trading is, guys, right? You need to weigh your leverage, weigh your risk. So if you're entering a contract, right, one trade that costs $500 and your account is 600, your leverage is only $100 because that's what's risk free. So you have really, 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 very like less space. You have a little bit space to breathe, right? When you're doing those types of trades. So you need to understand first, accept your account size, right? So if you're trading with 500, 2,000, 5,000, you need to first, guys, trading is not about having egos. It's not about being smart. It's not about who studies the most, guys. Like, book is going to help you. It can help you, learn stuff, but nothing can help you if you don't do it yourself, right? So that's why I say, like, the dumbest kid in school, right, can be the best trader, and the smartest guy cannot be the best trader. Oh, at the same time, the smartest guy can be the best trader. So that's how this doesn't matter. This game is not about being the smartest. It's not about being, the most studious. It's not about who has the biggest ego. It's not about who is, the best looking. Like, it's nothing about that, right? This is all about psychology, guys. It's 80% psychology. You guys think charting is hard, finding trades is hard. That's the easiest thing in this thing. It's the easiest thing to do. The hard thing is, managing your trade and, managing your money, guys. This is money management, right? You guys see these hedge funds that have millions of dollars. How do you think they manage their millions, if not billions, right? The majority of, proper, well-known hedge funds manage billions. So how do you think they can turn billions into more billions? And you're over here sitting with $1,000 and you can't turn that into 10,000. If you don't think you can't do that, then you're stupid. And this isn't probably for you. And you need to really, really just stay disciplined to your rules. So I'm gonna show you right now what are some rules that are good for you. Right, so number one, guys, sizing. If you pay attention, guys, this is a basic rule, but I will, this is very, sticking to an account that has a couple thousand in it, right? But I'm going to show you guys, there's, people on here with 200, 500, 2,000, 200,000, bro, 20,000. So sizing really needs to depend on your account, right? It's not going to be the same for everyone. And what sizing is, guys, is pretty much means how much of your account you are going to put in a trade, right? How much you are going to risk. So if you pay attention here, I'm talking about an account that has $25,000 in it. So that's my example, right? But I'm going to show you an example afterwards. If you have a 500, 1,000, 2,500. But for now, I'm going to show you 25,000. And it's the same psychology that applies to every other account size. You just have to switch the numbers up and the percents up. That's it. So never use more than 10% of your account in a position, right? That's the max. But at the same time, it doesn't mean that you have to use 10% in every trade, right? You can use less. It just depends on the type of trade you're taking and all the factors that go into play. If you guys remember yesterday in the lesson that we did, if you were there, or if you watched the recording that I posted, I talked about expiration date, right? The farther it is, the more less riskier it is, right? And if you're trading contracts that expire in the same day, you're taking an extra risk, right? And that's why I did recommend for you guys that have small accounts to stay away from trades that expire in the same day. That's just my opinion, right? You can make money with them if you do put a little bit of your money in it. But I do recommend you overall to stay away from that if you have a small account. So like I said, never use more than 10% of your account in a position. That doesn't mean you need to use the 10% every trade. You can use less. On a 25,000 account, your max position size should be under 2,500. Which, guys, if you know basic math, 2,500 is 10% of that account value. So this really helps you manage your losses. And if you keep them only 1 to 2% of your total account size, that really just reduces your exposure to the market, right? This is another word that I use a lot, and I get some people asking me, oh, what do you mean by that? So sometimes I would exit a trade, right? And I'll say, oh, I'm just reducing my exposure here, right? I'll exit a trade at 10%, right? Or 5% returns, which, that for us is a little bit. But, for most people, that's very good. But I would say, yeah, I'm reducing my exposure. What that means is I'm reducing my exposure to the market. I'm reducing my risk, right? Because the more, guys, if you have a $25,000 account, this is an example, the more money you put in the market, the more you're risking, the more you're putting yourself vulnerable, right? So the point of trading, guys, is quick in and out. You're not looking at months out. You're not looking at if this company is going to be alive in 10 years. You don't care about that. You care about what's going to happen within the next few hours, right? That's our goal. Quick in and out. So yeah, guys, how many losses it would take to blow up your account, right? Because when you look at people that have $1,000, they can put a 10% in each trade, and what is that, guys? That's $100 per trade. But some may say, oh yeah, that's too little, and yeah, I will agree with that. Sometimes you may have to put 20% of your account in a trade, but that's the risk you're taking when you're starting to trade with a small amount. And in my opinion, anything below, $5,000, $10,000, that range, anything below that, I would consider a small account, right? After you reach the 5-figure mark, which is 10,000, that's when I will say that, okay, that's a very good sized account. And that's where you should stick to the rule, no more than 10% of your account. That doesn't mean, like I said, you need to use 10% of every trade, right? But once you reach that 5-figure mark, that's when I do consider you sticking to that 10% rule. If you're underneath that amount, which, I think that a good majority of you guys are, I would say, yes, sometimes you are going to have to over-risk, but never over-risk your entire account. That's the difference. If you do that, then you should not be doing that. Never, ever, ever, never. And of course, what do new traders do? They do a couple of good trades, right? They make a few $100s, a few $1,000s. And they grow their account exponentially within 1 to 2 weeks. And then what do? They feel lucky one day and they put their entire account in because they want to buy a new car or they want to do something cool, right? They want to flex to their parents after they win or whatever bullshit it may be. And what ends up happening, right? You sized way too heavy on that account, guys. You sized way too heavy on that. So what happens? You blow your account. And that's what I'm showing you guys here in this lesson, how not to blow your account. So that's sizing, guys. Yes, sometimes if you have 1,000, you're going to have to risk more than 10% per trade. 10% of that is what, guys? 100. Sometimes you're going to have to risk 10 to 25%, right? But I would not do more than that, guys, Guys, over 25% is where you enter, the danger zone, guys. That's when you enter the danger zone, in my opinion. And obviously, if you're putting in 100% of your accounts, you deserve to lose all your money, correct? So guys, if you understand that, you're never going to blow up your account, right? Because you're sticking to sizing. And no, sizing is not the only thing that matters. A lot of things go into play. Okay, a lot of things go into play. It's not just sizing, but sizing is the foundation of everything else because everything else won't work without the proper sizing. Right, guys? So risk to reward is the other thing that I would talk about, right? Which is RR. When you see me say RR, that's what I mean, guys. Risk to reward. If you're risking $150 per trade and you want to make at least 200 or 300, or if I'm risking 1,000, I want to make at least 2,000 to 3,000 on it, right? That's a pretty high risk to reward. But that's the type of risk that you're taking day trading options, right? We're not investors. We're not waiting till we're 60 to be rich. We're high risk traders, guys. Trading is a high risk business. And I'm not No other person in this industry is gonna tell you how I'm gonna tell you. There's very few that will, right? And those few are good people. But for the most part, you guys, this is a high risk business if you're gonna get into this, right? But it is possible if you just take it slow and stay consistent and never over risk your account, guys. Like I have blown at least 10 portfolios, and each of those have been, $10,000, right? So I've blown over 6 figures in this market, right? I've given over 6 figures back to the market throughout the first year that I've started trading. After my first year, that's when I started taking it slow, calming down. And even if I made $200 on a day, I would be super happy, because you would do that, 5 times a week and you're up 1,000. Do that 4 times and you're up $4,000, right? So people don't see that math, right, guys? Even if you make $100 per trade, right? 100 times 5 days a week, 500, right, guys? Times 4, what is that? You're up $2,000. If you make $100 per day, you're up over 2,000 each month, right? And in a year, what does that up to, right? That adds up to over $24,000 in 1 year. So if you're a teenager, you need to prepare yourself and start compounding those gains, because by the time you're going to be 18, 20, you're going to have that capital to spare to be able to venture into other businesses. And that's what I've done, guys. I'm in other businesses, guys. I own Airbnbs. I own stuff, right? Because I took that risk 3 years ago when I was 15 years old. And, I just put my head down and I started being happy with that $200, $300, $500 days, until it eventually compounded up. So that's another word that I'm going to speak about afterwards, compounding. But that's more for the third lesson, which the title of the third lesson in this bootcamp is how to properly scale your account up. So right now in this lesson, we're focusing on how not to bring your account down, right? Obviously, your account is going to have days that's going to be down. Yes. But this lesson is how not to, blow your account. The third lesson will be how to make your account go up exponentially and consistently, right? We're not here to, become millionaires in 1 week, right? We're here to create a very powerful residual and consistent income, okay? So risk to reward, guys. You need to weigh your risk to reward, right? So if you have a $5,000 account and you're entering, say, $500, correct? Which that's 10% of your account, which I would say, okay, you're doing a good job, right? You're risking 300, 500, maybe some days you'll put $700 in a trade. That's fine, okay? You don't need to, you're not going to kill yourself if you can't, stick to that exact percent, right? Some trades, okay, put in 700, 600, that's fine, bro. But for the most part, just as long as you don't over risk and you weigh your risk to reward. So if you're putting 500 in a trade and your account is worth 5,000, how much do you want to make, right? And remember, not all of the time this market is going to give you what you want, right? You need to focus on what you need, and it's not what you need today. If you focus on today only in trading, you're not focusing on the next couple months. That's where greed comes into place, and that's where new traders fail, correct? Because you're just focusing on the now. You're not focusing on the next 2 months. What happens for the next 2 months? You grow your account 5% per fucking day. You're gonna have thousands of dollars, right? People don't think about that. They think about, oh, what's gonna happen today? What's gonna happen by Friday? Where am I gonna be at by the end of Friday? They don't look at 2-3 months from now, and that's why they're never gonna be successful. So that's why you need to weigh your risk to reward. If you're gonna put in that much, much do you want to make? You need to accept the fact, and you need to put a number in your head before you even enter the trade. Because by the time you're in the trade and by the time you're up, you know not to be greedy and you know to sell, right? And another thing that beginners ask me is, oh, how do you know when to sell? How do you know the perfect time to sell? How do you know the bottoms? How do you know the tops? Guys, you fucking don't. I'm not a wizard. I'm not a god. No one in this world has a magic ball that will tell you exactly when to buy and exactly when to sell. You can only estimate around. So that's why when you sell and you take profit and it keeps on going up, don't be mad, guys. That's what happened. You can't predict exact every time. Like, are you fucking stupid? If I couldn't predict every time, I would not be here talking to you guys. Guys, I would be on a fucking yacht right now in fucking, wherever the fuck. You guys have to be happy with your profits, okay? So guys, you're gonna hear this word a lot. and it has a lot of different meanings. And risk management is a section that contains sizing, risk to reward, all of that, right? Developing consistency. All of this, guys, is my course. And it's, if you guys have not read it already, it's 30 pages long. I don't have the time right now to go through each page, but if you do want to go through it and take notes, I highly recommend you do. Okay, guys, I really recommend you do. Guys, don't bag hold. What does bag hold mean? Right? It means that you're basically playing off hope. Guys, if you enter a trade and you're really over risking it, you guys need to know when to cut and when to take profits, right? Like I said, risk to reward. Before you even enter the trade, you need to learn and you need to set points where oh, okay, if it reaches this, I'm out. I'm happy with that profit. Or if it reaches this amount of loss, all right, I'll accept the loss. That's the max I'm willing to lose, because if I lose more, it's going to really affect my account. And it's going to be hard for me to make it back. So that's why you can't bag hold your losses, right? And at the same time, people think only bag holding applies to losses. It applies to wins, guys. Don't bag hold your wins, because what's going to happen? You guys know that every option contract is basically designed to go to zero, if you guys didn't know that already. Right? So most people don't know that. So if guys are bag holding your wins, it's the same thing as bag holding your losses. Because if you're bag holding your wins, eventually you're going to hit the top of that price. And, you could have sold there, or you could have sold a little bit before and still made profit. But instead, you're holding the green trades, expecting it to go 5 million%, and you end up selling for a loss. So that's why you shouldn't bag hold any trades, period. You should accept your losses and accept your wins as they are. And you need to set reasonable numbers, not crazy numbers, so that you can, consistently develop your account into a higher amount day by day, and focusing on a few months out. Not focusing on, oh, am I going to be a millionaire by the 12 o'clock in the afternoon, right? So get that out of your fucking head, okay? Guys, and I'm going to read you off my course right now. I wish it was that simple, right? In some way it is. A lot of day traders take big losses simply because they refuse to cut a trade in the hopes it will turn green again. Now, there will be situations where that does happen, right? And let me elaborate on that, right? You'll be down 90%. And yeah, there'll be times where, that trade can go back up. And that's happened to me a lot of times, right? It still happens to me. And, when I'm trading these high-risk trades, they'll go up back up after being down a reasonable amount, right? But like I said, sizing, I had a little bit amount in that trade, guys. So I'm fine with, there's different type of trades, and that I'll explain that in the third lesson, but I'm gonna explain it a little bit right now. So guys, there's high risk trades, there's high probable trades, there's safe trades. Guys, I hate when people ask me, oh, can you find a trade without that much risk or a less risky? Guys, every trade is fucking risky. Every trade you put in your account, you're risking losing money, okay? But you can also make money. So that's what the probability chances we're taking as being traders, right? That's what this is. It's a probability game. Like I say here, it's a probability game, right? And the chances of profitability in the long run are more in your favor if you cut your trades when you planned to cut them, like I've been saying in this lesson. You can't get married to one specific trade, guys. You cannot get married to one specific trade. It's just one out of thousands you'll inevitably take, okay? I went ahead and muted that person. A common theme I notice, in beginner traders, guys, they let trades go red without cutting, hoping for them to turn back green, right? That results in big losses, guys. And they cut green trades too fast because they're scared for it to turn red again, right? So there's a strategy, guys, where you can take your safe profits, then leave runners in your contracts that are risk-free. So even if they go red, you're still going to make money off that trade. And that I'm going to go in depth in my third lesson, guys. But for now, you need to understand, you need to accept your wins and accept your losses, because they're both going to fucking happen. And the only thing you can do as a trader is manage your wins and manage your losses, because both of them are fucking guaranteed. This mentality seems to be ingrained in most new traders' heads, right? Like I'm saying. You are scared to let profits go and refuse to cut trades for a loss. Switching this mentality is what will lead you to success. You should be scared to let your losses grow and refuse to cut trades for small profits. Okay? That's what trading is, guys. We're not here to make 5% on a trade, right? We're here to make 15, 20%, 40%, right? But we're also not here to take losses that we're gonna blow up our whole entire fucking account, right? So there's two sides of it, and if you can master both sides, you're gonna be fucking successful. And trust me on that, guys. So yeah, guys, this is pretty much what risk management is, guys. You need to know your sizing, how much of your account you're willing to risk in a trade, guys, and your risk to reward. If you're gonna enter a trade, you need to know how much you're willing to lose and how much you want to make, right? Or how much you need to make. Okay, guys? So risk to reward is not only for wins. It's not only for how to take profits. You're risking how much you're willing to lose and how much you're willing to win. Okay? Sizing, risk to reward, and don't bag hold your trades. Okay? The good part about my setup is that most of the time this is feasible since it's play reversals, right? This is more, I'm going to go into depth in the other lessons, how to find your trades and stuff. But guys, stop loss is another thing that I want to talk about, right? Because stop losses is something that I am very, tedious about because I have my way of doing it. And, most traders on YouTube or wherever the fuck, they're not going to tell you how I'm going to tell you, right? So I hate when people tell me, oh yeah, man, just use a negative 20% stop loss on every single trade you take, right? Because that's not a good way to say it, because not everyone has the same amount of money in their trading account, so not everyone will be using the same rules. So since I call out trades and someone with a $200,000 account or someone with a $2,000 or $200,000 or $20,000 account, I am calling the same exact trade, but it's not the same exact trade to everyone else because everyone else doesn't have the same exact account size. So technically, if I call out a trade, it's a different trade for each and every single person in this Discord. So that's why I'm not going to tell you guys a stop loss for it. I'm going to want you guys to learn how to properly manage your account yourself, how to become a self-disciplined trader, how to become your own boss. That's the goal of this. This is the goal for me to, have an interview with a student on my YouTube, guys. He made over $3,000 in one. He made, 3,700. I think that's the number. Almost 4,000, guys, in one day. And he's a 19-year-old college student. And he pulled out his phone, shown his account, and refreshed it. Guys, there's no bullshit about this, right? You guys need to understand. You need to manage your own, right? So I hate when people say that, guys. When they say a stop loss for every single person, because every single person has a different account. Right? So I'm just going to give you guys an example of, a stop loss with an example of an account. So this numbers can, vary in your account size. And, in the third lesson, I'm really going to show you guys how you can determine your own numbers and how to determine the proper numbers that you should apply to your rules. So guys, an example, $10,000 account, using 1,000 in a position, which is 10%. Okay, that's fine. I'll tell you, if you have a $10,000 account, use 800, 700, 500, 1,000, 1,500, 1,300, right? That range is, that's fine to me. I'm fine risking that. But I'm willing to take a 15% loss, negative 50, right? In order to make it a 20 to 30% win, which is 200 to 300. And that's what risk to reward is, right? You're willing to lose 15% to make 2 to 3%. And if you guys know, some experienced traders in this voice call, that's a 1 to 2 reward, risk to reward, because you're risking 1 to make 2. So you're risking 15% to make 30% when 30% is double of 15. So you're risking 1 to make 2. So that's a fairly good strategy. So some people may, pan it out. You might be risking 1 to 1, right? You might have a 1 to 1 risk to reward, which that would be, you're willing to risk a 20% loss to make a 20% win. You're risking 1 to make 1. That's fine. You can risk 1 to make 2. You can risk 1 to make 3. Or you can risk half 1 to make half 1. This is what is trading, guys. These numbers is what matters. Right, guys? You think it's hard to read charts, resistance, all of that shit is gonna come naturally when you guys observe the charts in the Discord. Like, don't focus too much on that. That's gonna come naturally when you're looking at TradingView. Guys, this is what you need to focus on if you want to make fucking money, right? So yeah, guys, that's that's pretty much fucking risk management and what you guys need to know. You guys have any questions? Any questions, guys? There's no such thing as a stupid question, guys. I don't want you guys to be afraid to ask me anything ever. In the chats or in DMs. Sometimes I'm not gonna respond because or I may be traveling, or I may be driving, or I may be at an event. But usually, guys, I will get back to your messages at all times, right?
Hey,
Just to go back to sizing, could you do an example with a really small account, like where you're saying like $500? Because you did
Yeah.
one with 25,000 and 1,000. So just could you do a smaller one?
Yeah, of course. I was gonna do that. Thank you. Look. So guys, let's do an example right here, 500, okay? So, let's just get the brush out here. Let's say with the $500 account, guys, like I said in the beginning, if you're with a small account, you need to understand you need to take the risk that you're willing to take, right? When you're getting to trading with that couple few $100s, right? And in my opinion, that's a very small account, but that doesn't mean you can't do anything, right, guys? I started with $200, okay? I started with $200, and I'm buying a Lamborghini in the end of this month. So anything is fucking possible. So if you guys are with a $500 account, guys, you need to understand that you are going to be having to use more than 10% of your account. Okay, like I said, you're not going to necessarily have to be using half your account in a trade, right? You're not going to have to be using all of your account in a trade. Definitely fucking not. But you are going to sometimes have to use more than 10%. So an example, guys, 10% of this is 50, correct? That's 10%. Okay? 20%, guys. 100. Okay? So that's double that. Correct? That's double that. So you're taking double the risk if you're not risking 10% and if you're risking 20%. And in my opinion, risking around 20% for that account, that's fair, because that's $100, right? And if you have $100, you're leaving basically 400 rest of your money to you for leverage, right? Like I said, guys, what's leverage, guys? If you have a $600 account and you're entering one trade that costs you 500, you don't have much breathing room. But right, if you have a 500 and you're entering with this, you have $400 of room, right, guys? Of leverage. You have that. So sometimes you're gonna have to risk 25%, right? Which is 125, I think, not 150. My math is off. Right, guys? So you're gonna have to be risking that. I think it's like 130. I don't know the exact amount. Okay, this guy tells me to ban this. Guys, by the way, if a fake me adds you guys, there's a lot of impersonators lately. It's crazy, guys. I'm not even kidding. It's at least like 30 accounts a day. 30 accounts every day that make accounts that look like me with the same profile picture, same name. And they try to do bad stuff to people. So you guys be careful with that, please. But yeah, man, boss man, I believe it was you that asked. That's the example, guys. If you have a $500 account, it's fine for you to risk that 25% if you have to. Okay? But as your account grows, you want to tune that number down as your account goes up. So as your account goes up, and remember I told you guys example 500. 500, correct? As your account goes up to that, right? Guys, as your account goes up, my DPI just glitched on my mouse. There we go. As your account goes up, guys, if you're risking 20% / 25% in here, as your account goes up, you're gonna be risking less, right? 10 / 15%. As your account goes up, you're gonna stick to it. Or maybe here 20%, right? Then here 15%. Then here 10%,
to send like
right?
very odd, weird, anonymous letters to Lauren, and then it'll be like,
Sorry guys, I went ahead and muted him. But yeah, like I said, man, when you're starting off with $500, that's a good number for you to give me an example, because that's a weird point, because you have to over risk more than 10%, like I've shown you guys. But as your account grows up, and it's not gonna take you guys long, you can do this shit in less than a month, right? As your account goes up, you're gonna have to want to bring that percent down, tune that percent down to the proper numbers, and that's the risk you're willing to take, bro. If you're trading with a small account, that's it. That's all it is, bro. So yeah, I hope you answered your question, man. And you guys have any other stuff, other questions?
Yeah, not really a question necessarily, but I just want to say thanks for putting that course out because I over the past few days I took notes on it, and last Friday I went 5 for 5 on trades just using your strategies and what you taught in that course. So I just wanted to give a huge thanks to you, bro.
Awesome, man. I like it, and losses are guaranteed, man. I take losses too, bro. I take losses every week. My guy Oculus takes the loss every week, right? I take loss. Everyone does, bro, and that's the beauty of the game, because guys, in this game, the best loser is the winner in the end, right? So if you're a good loser, and if you focus on managing your losses, you're gonna have good wins, right? And you're gonna be consistent because you're keeping your losses manageable, right? You're not gonna over risk your account. So that's why I love saying that saying. The best loser in trading is always the best winner. Because if you're good at losing, you're a good loser. You don't let your losses, blow up your account. Then you're gonna be a winner, and you're gonna make money in the long run. So yeah, guys, I really hope you enjoyed this lesson. I truly do. We're gonna have our second part today, which is gonna go more over how to scale your account up. This lesson is focused on losses and how not to blow your account like an idiot, and like how most new traders do. And yes, it might have happened to you. It happened to me definitely when I started, and it's okay. But guys, if you want to be a successful trader, ask any trader that has made 6, 7 figures from the market. Ask them how their trading journey was in the start. They're gonna tell you the same shit. Oh yeah, I blew my account, whatever. You're never gonna ask a 6 to 7 figure trader, and they're gonna tell you, yeah, man, one day I just got my account, bro. I loaded up with 1,000, and I never. It's been like that since then, bro. Just going all the way up, bro. No, I'm here. That's it. No one is like that, guys. No one. Everyone has blown their shit at some point. So if it's happened to you, be happy, because that's where you gotta learn from your stupid mistakes that we all made. And that's part of every successful trader, guys. If you haven't failed, you can't be successful. The most successful people are the people that have failed the most, and the biggest losers in this world are the people that have failed the least because they give up. So yeah, guys, without further ado, I'll be able to end the lesson here. Any questions, guys? Feel free to text me in the pro chat. And I really appreciate
I would
you guys
have a
coming
few
up.
points, if you don't mind.
Of course, man.
Yeah, in fact, it's more to have your opinion about these. It's notes that I left for myself, not to repeat the same stupid mistakes over and over, and I think that would be valuable for others. I was wondering, let's say you have a bad entry. How do you manage this? Me, sometimes I would get stubborn, and then I would keep averaging down on it, even though it would be a losing position. What I'm trying to do more days is maybe to set a limit order. If I miss the play, then too bad. There's going to be always another play. I don't know if you act this. Are you hitting the ask, or do you more often try to bid low, and if you miss it, you miss it? And
exactly. So listen, for me, I went over that in the first lesson. I'm not sure if you were there, but for me, I don't try to slap the ask personally, unless I'm trading SPY or something on 0DT, because the bid and ask spread is gonna be tight, right? So I don't have an issue buying the ask, but most of the part, I want to make a good entry, right? And I'll be honest with you guys. I'm transparent, right? Say I'm getting in a trade that costs $1, which is 100, right? If you were in the lesson yesterday, you understand why. If I'm entering at $1, and I signal it, and it goes up to $1.05, I'll tell you guys, oh yeah, just enter, it's fine, because guys, it's a trillions of dollars in the market, right? And we're just some small fish, right? Well, you need to understand that you need to be, you can't always be the same entry, right? If all 300 of us enter a trade, we're not all gonna get the same exact price. So you need to understand that. So that's why missing entries, you're sometimes gonna get even a lower price than me. I'll enter at $1 and I'll signal it at $1. And guys, when I signal, guys, I type like 120 words per minute. I'm a very fast typer, and I send my signals out like pretty much as I'm entering. So that's not a worry. But sometimes I'll enter and I'll signal and it'll go down a bit, like it'll go down 5%, 10%, whatever, 7%. And you're gonna get a better entry than me sometimes, or you're gonna get a higher entry than me, and that's fine, right? But there has to become a point where you have to set a max reasonable amount to not trade. So if, for example, rare cases, guys, the market is volatile. If I alert something at $1 and it's already up to $1.20, right? It's already up 20%. You should not enter it. That's very rare cases. Say your internet was slow, say you couldn't load up Discord, whatever. That's you gotta set your numbers, guys. If it's over 15%, 10%, 20%, I would not probably enter that. So I believe your question was, how to deal with, missing your entries and maybe averaging down. And when it comes to averaging down, I think averaging down is a great tool because you're using your leverage that you have. So for example, I've shown you here an example of $500, right? So if you're risking $100, which is 20%, you're leaving $400 for leverage. So when you average down, and guys, averaging down, by the way, or doubling down, like he said, is when you buy a trade and you're down on it and you buy more to bring your average cost down. Right, guys? So average cost is this. Average. Say 1.0, which is 100, right? And say you buy this one, right? You're in with 100. And then say it goes down to, this is just for hypothetical purposes. Say it goes down to 0.50. So you're down quite a bit, right? But you only have one contract, so you're down $50. And then say you buy another one. You buy another one at this. So now you have two total. What is your new price, guys? 0.75. That's your new price. Even though that's not the price of the option, which is now it's this, that's not the price of the option. That's what your average price is. So remember that also. That's kind of what new traders have confusing, because the intra trade and at $1 it goes down to 50, and that's the value of the option, but your value that you bought it at, it's $1, so you're down, right? But if you buy one at $1, it goes down to 0.50. You buy another one, your new average price is 0.75, right? Basic math. So when it comes to averaging down, I think you should only average down when you have the appropriate leverage size and you still think that the trade setup is valid and it has not been invalidated by your levels, right? So for example, I've shown you have $400 leverage. Okay, average down once. That's fine. But there has to become a point where you set a max point at your leverage that you have left over in your account, which is the leftover money that you have, other than the original amount that you put in your trade, because that's what you're willing to lose. You're sizing with your RR. That's the space that you need to, okay, after this, I'm not adding anymore. That's the max I'm willing to lose, okay? And if you're already too sized in, if you're already risking a lot that you're not comfortable adding in, averaging down, then don't average down. Just take the loss instead of, potentially hurting your account even more. So that's what my recommendation to you is.
Thank you so much. I agree with you 100%. It's like the general with his army. If you lose all of your soldier, how you're gonna counterattack later on. So at one point you have to know that I'm gonna lose, and that's it, and to prepare for another time.
Yeah, prepare for the next war. You want to have backup, so your backup
exactly,
is your money.
Not to revert.
Never.
Also,
Like if you're in a war, you're not gonna send all your armies and all your tanks out in one time. Correct? You're only gonna have backup. So that's the same thing here. So great analogy. Thank you for that.
Oh, you're welcome. I was wondering, sorry, a follow-up question, if you don't mind.
No, of course, bro. Ask.
In regards to risk reward, I often see a mistake that people do. Let's say they buy a contract for $100 and they're like thinking, okay, well, I want to make another 100. Often they don't follow price action. I mean, once it hit a resistance or something, they'll be like, okay, I'm just up 75. I said I would stop at 100, and then they keep holding, like you said, bag holding, and then it goes down and the trade goes red. So
Exactly.
I was wondering, do you check more the price action, like supply resistance, and at one point you're like, okay, I made enough money. Here, there's a supply zone. I'm cutting it. I'm taking
Exactly.
how much I
So
got. Or
my risk to reward really depends on, how much I put in the trade and where the chart is. So for example, if I've already made a decentable amount of money, but I do think that the stock, like say I'm in calls, right? And I think that the stock is still strong and I still think that there's room, I'll still hold it for a little bit more, right? Because we all want more money, right? Money is our happiness, basically, guys. Why are you guys in this Discord? To make fucking money, right? So we all want money. So if I see the opportunity to make more money, I am going to, hold it a little bit longer. But yeah, like you said, it all depends on where the chart is and, if I'm happy with my gains for that one trade. It just depends on a lot of stuff. And, that's really going to be in our third lesson, which is how to scale your account, fast and safely. And here I have a section, I believe it has doubling down, cutting losses. That's going to be in the third lesson. Profit taking, for example, like you said, it depends on the demand, right? The volume. I like to take some profits when I'm up, a decentable amount, and then leave runners. For example, SPX on Friday, I was already out majority at 300% or 280%, something like that, and it went up to 400, and I had 5 contracts left, and I sold the 5 when it reached that, right? So people think, oh wow, you made 400%, you probably made $1 million. No, I didn't make $1 million. I made a good amount of money, but I was already out because I wanted to be safe, and then my runners ended up, making that big percentage. So when you guys see traders that are making 1,000%, guys, they're most likely already sold most way before that. So be realistic, guys, okay? So yeah, that's that.
good stuff. Thank you.
Of course, anytime. I appreciate you. And yeah, guys, any other questions? And if you have another question, afterwards, say you don't have one now and then you have another one, just ask in the chat. And, we'll be able to help you guys. So I'll do another one, 10 p.m., guys, Eastern time, which is, in around a little bit over 4 hours from now. I'm going to go ahead and chill a bit, go outside. And yeah, guys, I hope you enjoy the rest of your afternoon. And we shall see each other in the other lesson, okay? I hope to see you there, and I'll be able to upload this session as well, okay? I'll see you guys later. Thank
Take
you.
care. Buenas noches.
Okay, bye.
Bye.